Hi there, it's Friday the 2nd of November 2018. I'm Steve Towers. Welcome to International Tax Bites, ITB. Let's get started. Well, the UK has taken the plunge. In this week's budget, the UK government announced the introduction of a digital services tax, effective the 1st of April 2020. The tax will apply only to social media platforms, search engines, and online marketplaces, on the basis that these operations are considered to generate significant value from user participation. The tax will be imposed on revenues which are linked to UK users. For example, revenues derived from facilitating transactions between UK users or from displaying advertisements which are targeted at UK users. The DST, as currently proposed, will not apply to other digital services. For example, payment services, provision of online content, licensing of software or television services. The DST will apply only to large businesses that are profitable and which derive more than £500 million per annum in global revenues from the in-scope activities, social media platforms, search engines, and online marketplaces. And the first £25 million of revenue from such activities generated from UK users will be exempt from the tax. Interestingly, the DST rate will be 2%, which is less than the 3% rate in the current European Commission proposal. There will be a safe harbour for loss-making and very low profit margin businesses. The government hopes that a global solution will emerge. If it does, the government will consider adopting it instead of the DST. In any event, the DST will be formally reviewed in 2025. It will be disapplied if a global solution is in place by then. A public consultation on the design of the DST will be launched in the next few weeks. The DST will be included in the Finance Bill 2019-20. Well, it didn't take the US government long to criticise the UK DST proposal. House Ways and Means Committee Chairman Kevin Brady issued a fiery statement on Wednesday, including this threat. If the UK or other countries proceed with a DST, that will prompt a review of our US tax and regulatory approach to determine what actions are appropriate to ensure a level playing field in global markets. And this week, there were other criticisms of the EU DST, the UK DST, and or the Spanish DST from the US Chamber of Commerce and a group of 16 European digital companies. The 16 European digital companies were in turn criticised by Paul Tang, a member of the European Parliament, who was quoted as saying that it is disturbing to see that these companies do not want to contribute to society. Oh dear. And just to balance out the scales, a Canadian professor has published a paper called The Digital Services Tax, a Conceptual Defence. Meanwhile, the EU member states are still trying to reach a consensus on what to do. Some of the issues which are currently being discussed are these. Would the DST breach double tax treaties? Austria, in the EU presidency seat, says no, the DST would be an indirect tax outside the scope of double tax treaties. Others say that it's a surrogate for a corporate income tax, and thus it would be a blatant bad faith device to avoid Article 7. And would the DST cause double taxation? No, says Austria. The DST would be an indirect tax levied by the destination country. No other country would be entitled to levy an indirect tax on the same revenue. But others say, but what about double taxation between the DST and corporate income tax in the residence country? Will the residence country grant a foreign tax credit for the DST? As you can see, the fundamental issue is the character of the DST. In legal form, it would be an indirect tax, but we all know that it's a surrogate for corporate income tax. So, what is it? Here's a list of the DST-related documents which you can access at our website or app. And now for the developments in Asia Pacific. In Australia, the tax authorities have issued the final version of guidance in regard to the application of the General Anti-Avoidance Rule, Part 4A, to restructuring to avoid Australia's hybrid mismatch rules. Let me quote from the introduction. Concerns have been raised about the potential for the Commissioner to apply Part 4A to cancel all or part of a tax benefit where the taxpayer restructures an existing hybrid arrangement to avoid the application of the hybrid mismatch rules. This may involve, for example, replacing a hybrid financing instrument with a debt instrument to eliminate tax benefits in another country, but preserve tax benefits going forward in the form of deductible debt in Australia. This guideline is designed to assist taxpayers to manage their compliance risk in these circumstances, where their intention is to eliminate double non-taxation outcomes, consistent with the underlying objective of the hybrid mismatch rules. It does so by outlining restructuring that the Commissioner considers to be low risk and to which the Commissioner would not seek to apply Part 4A. The guidance considers 6 scenarios. For each scenario, it considers the hybrid mismatch arrangement and the replacement arrangement, which in each case is described as straightforward restructuring that merely removes the hybrid element of existing arrangements whilst keeping the surrounding facts and circumstances unchanged. For a copy of this guidance, please go to our website or app. Also in Australia, the tax authorities have issued draft guidance on the interaction of the transfer pricing rules and the debt equity characterisation rules. The draft guidance indicates that the transfer pricing rules operate first. If the effect of their operation is that arm's length conditions are deemed to apply, then the debt equity characterisation rules are applied to those deemed arm's length conditions. For a copy of the draft guidance, please go to our website or app. In Hong Kong, the Legislative Council has passed the bill which increases the tax deduction for qualifying R&D expenditure, which was announced early this year. Under the new provisions, qualifying R&D expenditure will generate a 300% deduction for expenditure up to 2 million Hong Kong dollars, which is about 250,000 US dollars, and a 200% deduction for expenditure exceeding that amount. To be qualifying R&D expenditure, the R&D must be performed in Hong Kong, although some subcontracting is permitted. In addition, the Hong Kong taxpayer must own the intellectual property rights which result from the R&D. In India, the Pune Income Tax Appellate Tribunal has decided a case in regard to the 2012 retrospective amendments to the definition of royalties in India's domestic tax law. Those amendments in 2012 were stated by the legislature to have retrospective effect from 1976. This is not the first case on this topic, but it is a useful reminder of the limits of retrospective legislation. The taxpayer company made payments to Amazon US for web hosting services. These payments were made prior to the 2012 amendments to the definition of royalties. The taxpayer company did not withhold any tax from the payments. The tribunal accepted that before the retrospective amendments were made, the payments for the web hosting services did not qualify as royalties under Indian domestic tax law because the taxpayer company had no control over Amazon's servers. It therefore was not paying for the use of or the right to use Amazon's equipment. However, the tax authorities argued that by virtue of the retrospective amendments, the payments were retrospectively royalties, and that therefore the taxpayer company was required to withhold tax. As it had failed to do so, it is to be denied a deduction for such payments. The tribunal rejected this claim for two main reasons. Firstly, the tribunal held that the retrospective amendment cannot create an obligation on the taxpayer company to have done something in the past which was not legally required at that time. It said this: "We hold that amendment to the scope of royalty by an amendment in 2012 with retrospective effect cannot fasten the taxpayer company with liability to withhold tax for the years which have already been closed prior to insertion of amendment. Hence, the taxpayer company has not defaulted in not deducting withholding tax, and for such non-acts, the payment made cannot be disallowed as deductions." The tribunal's second reason concerns the India-US double tax treaty. Amazon US is entitled to claim benefits under that treaty. The tribunal accepted that the payments for web services did not satisfy the definition of royalties in the treaty. And importantly, according to the tribunal, amendments to India's domestic law definition of royalties could not have impact on the treaty definition, for the simple reason that the US had not agreed to those amendments, whether retrospective or prospective. In regard to retrospective domestic law amendments, I think the tribunal is totally correct. But in regard to prospective domestic law amendments, there's always the issue of whether Article 3.2 with an ambulatory interpretation can apply. And that's a particularly interesting question when the domestic law amendment is not to the actual term which is defined in the treaty, but to a component of that term, where the component is itself undefined by the treaty. I'll leave that topic for another day. In New Zealand, the government has now introduced into Parliament the bill and commentary in regard to the R&D tax incentive, which will be effective in the 2019-2020 income year. I mentioned this proposal in ITB on the 5th of October. For a copy of the draft bill and commentary, please go to our website or app. In the Philippines, there are some interesting legislative developments. Firstly, the corporate tax reform, which was originally called Train 2. The bill which is proceeding through Congress is called Trabajo, which stands for Tax Reform for Attracting Better and High Quality Opportunities. Trabajo has been passed by the House of Representatives and is currently before the Senate. Commentators expect it to be passed by the Senate in the near future and to be signed into law by the President in time for a 1st of January 2019 start. The two headline changes which Trabajo will make are, firstly, from 2021 to 2029, a progressive reduction in the corporate income tax rate from the current 30% to 20%. Although I should note that there is some interest in the Senate in changing this to a reduced tax rate of 25% effective 2019. And secondly, a significant reduction in the number of tax incentives which are provided to companies. And in regard to tax incentives, the Philippines Department of Finance has issued a strong statement which criticises the indiscriminate grant of costly fiscal incentives. For a copy of this statement, please go to our website or app. And another interesting item of proposed tax legislation in the Philippines would introduce a single fiscal regime for the mining industry. This bill is also proceeding through Congress. The bill has these key elements. It would impose a royalty tax with varying rates dependent on factors such as whether the operations are large scale or small scale, and on whether the operations are within or outside mineral reservations. It would also introduce a margin-based windfall profits tax. Interest expense deductions would be limited under a 3-to-1 debt-to-equity thin capitalisation rule. And there would be a ring fencing of each mining operation. No consolidation would be allowed. And there's been an important achievement in the world of trade. The Comprehensive and Progressive Agreement for Trans-Pacific Partnership, the TPP-11, has now been ratified by 6 countries, which means that it will now go into force on the 30th of December. You'll remember that the TPP-11 is the agreement which was salvaged from the proposed Trans-Pacific Partnership after the US withdrew in 2017. It has 11 signatories, hence the name TPP-11. The 6 countries which have ratified it and where it will start operation on the 30th of December are Australia, Canada, Japan, Mexico, New Zealand and Singapore. With the agreement starting operation on the 30th of December, it means that there will be 2 tariff reductions in 3 days, on the 30th of December 2018 and on the 1st of January 2019. And now for the developments in Europe. The European Court of Justice has decided a VAT case on referral from Slovenia. The taxpayer imported into Slovenia goods from a third country, a country outside the EU. Ordinarily, VAT would be charged on import. However, the taxpayer was exempt from import VAT because he stated that the goods would be transferred to another EU member state, Romania. At a later stage, the Slovenian authorities discovered that some of the information which the taxpayer gave in regard to the identities of the Romanian buyers was incorrect. and it also discovered that the purchase of the goods by the Romanian buyers was part of a VAT fraud scheme. In these circumstances, the question which was posed to the court was whether the taxpayer's exemption from import VAT should be withdrawn. The court said that the critical issue was whether the taxpayer acted in good faith and took every step which could reasonably be asked of him to satisfy himself that the transactions carried out would not result in his participation in tax evasion. If, based on objective evidence, the taxpayer passes that test, then the exemption from import VAT cannot be withdrawn, despite the VAT fraud by the Romanian buyers. For a copy of the decision in this case, please go to our website or app. In Italy, the tax authorities have issued guidance on the tax treatment of a so-called classic repo transaction over government bonds. For a copy of this guidance, please go to our website or app. In the Netherlands, the government has launched a public consultation on its proposals for legislation implementing ATAD 2, which deals with hybrid mismatch arrangements involving hybrid and reverse hybrid entities, hybrid instruments, hybrid PEs, hybrid transfers, imported mismatches, and dual resident entities. The proposed legislation would generally be effective from the 1st of January 2020 as required by ATAD 2. Under these new rules, the Dutch CV-BV structure would be adversely impacted from the 1st of January 2020. From that date, payments by the BV to the CV would generally not be deductible. However, in accordance with ATAD 2, the package of new rules also would require a reverse hybrid entity, such as a Dutch closed CV, to be treated as a Dutch tax resident if it is formed under Dutch law, effective from the 1st of January 2022. At that time, payments from the BV to the CV would be subject to Dutch tax in the hands of the CV, and thus the structure would no longer be a hybrid mismatch arrangement, and the denial of the deduction for the BV would be withdrawn. One other change which is proposed is that the 2005 CV-BV decree regarding the application of the Netherlands-US double tax treaty with respect to such structures will be withdrawn effective the 1st of January 2020. This would mean that dividends paid by the BV to the CV from that date would generally be subject to 15% Dutch dividend withholding tax. The public consultation will be conducted online and is open until the 10th of December. For the link to the consultation website, where you will find the consultation document, which includes the draft legislation, please go to our website or app. Also in the Netherlands, we now have clarity on the corporate income tax rates for the next few years. The current rates are 20% for taxable income up to €200,000 and 25% on the excess above that amount. In 2019, the rate for the first €200,000 will drop to 19%, but the 25% rate will remain for the excess over €200,000. In 2020, the first €200,000 will be taxed at a 16.5% rate, and in 2021, it will be a 15% rate. For the excess over €200,000, in 2020, the rate will be 22.55%, and in 2021, it will be 20.5%. In Poland, Parliament has passed the legislation which I described in ITB on the 7th of September. This legislation covers a number of interesting topics. introduction of a BEPS-compliant innovation box regime, new withholding tax anti-avoidance rules, and implementation of ATAD 1, including the introduction of the exit tax rule 1 year ahead of the required date. Spain has decided to introduce a financial transaction tax as a unilateral move. It's not waiting for the other 9 EU member states within the FTT group, with which it has been discussing this topic as an enhanced cooperation procedure for many years. The FTT has been included in Spain's draft budget bill. It would have a rate of 0.2% and would apply to the acquisition of shares in publicly listed companies with market capitalisation exceeding €1 billion and depository receipts which represent such shares, with some exceptions. The government has launched a public consultation on the proposed FTT, with comments due by the 15th of November. For information on the consultation, please go to our website or app. And as I've already mentioned, the UK presented its 2018 budget this week. Apart from the 2% DST, here are the items that caught my eye. Let's start with the corporation tax rate, which is currently 19%. The budget did not indicate any change to the scheduled reduction of this rate under legislation enacted in 2016. Accordingly, the rate will fall to 17% on the 1st of April 2019. Remember the proposed extension to the royalty withholding tax rules, which was announced in the 2017 budget? Well, that has been significantly changed. There will be no withholding tax. Instead, the UK will impose income tax directly on a non-resident based in a low-tax jurisdiction, which derives royalties which are referable to the sale of goods or services in the UK. For this purpose, royalties means actual royalties and embedded royalties. This new rule will apply from the 6th of April 2019. However, there's also an anti-forestalling provision which will apply from the 29th of October 2018. There are 2 proposed changes in regard to intangible fixed assets. Firstly, there will be a partial reinstatement of relief for acquired goodwill. This reverses a change which was announced in 2015. And secondly, the degrouping rules will be amended to provide an exemption if the degrouping is caused by a share disposal which qualifies for the substantial shareholding exemption. And the use of capital losses will be restricted in line with the way that income losses are currently restricted. Thus, from the 1st of April 2020, companies with capital gains exceeding £5 million will be able to utilise capital losses to shelter only 50% of the excess over £5 million. And now to Africa. The IMF has issued a working paper which investigates whether double tax treaties between countries in sub-Saharan Africa and investment hubs such as Mauritius are beneficial for the African investee countries. The paper's conclusion is, no, they are not. The paper puts it this way. We analysed the cost and benefits of concluding double tax treaties with investment hubs on FDI and government revenues for a sample of African economies. Our results imply that these economies are likely facing a substantial reduction in revenue when signing a treaty with investment hubs. At the same time, we find no evidence substantiating expectations of a corresponding benefit in terms of additional investment generation. The value of tax treaties to attract investors thus remains uncertain at best, especially where investments tend to be aimed at a country's natural resources or specific market. For a copy of this paper, please go to our website or app. In South Africa, you'll remember that the government is proposing to expand the scope of digital services which are subject to VAT on inbound supplies. I covered this topic in ITB on the 8th of October. Well, the government has now issued the amending regulations and an explanatory memorandum on the changes. And I should note that this is important in both B2C and B2B situations. Unlike most countries, South Africa does not apply a reverse charge mechanism in B2B situations for inbound services. Under the VAT legislation, VAT is imposed on electronic services, which is defined to mean those electronic services prescribed by the minister by regulation. Under the current regulations, a list of specific services is prescribed. Under the amending regulations, that list is deleted and is replaced by a definition which says any services supplied by means of an electronic agent, electronic communication, or the internet for any consideration, other than some exceptions, which I'll discuss in a moment. As you can see, the main part of that definition is very wide. However, there is this statement in the explanatory memorandum. The policy intention is to subject to VAT those services that are provided using minimal human intervention. Hence, for example, legal advice prepared outside the Republic by a non-resident and sent to a person in the Republic via email will not be subject to these regulations. The download of a movie or the provision of the right to use an app, for example, may be subject to these regulations if all other requirements are met. There are 3 exceptions in the definition. Educational services, which are regulated by an educational authority in the export country. Telecommunication services, but the explanatory memorandum makes clear that this exception does not cover the content of the telecommunications, and certain services supplied within a group of companies. The third exception, intra-group services, is expressed in this way. Services supplied from a place in an export country by a company that is not a resident of the Republic to a company that is a resident of the Republic if 1. Both those companies form part of the same group of companies, and 2. The company that is not a resident of the Republic itself supplies those services exclusively for the purposes of consumption of those services by the company that is a resident of the Republic. And in regard to the third exception, the explanatory memorandum says this: electronic services that are supplied by a non-resident company to a resident company that forms part of the same group of companies will be excluded from these regulations, provided that the services are supplied exclusively for the purposes of consumption by the resident company. An example of these supplies would be where an IT non-resident company supplies IT solutions of its own to a company in the Republic, where both such companies are members of the same group of companies. Where, however, such non-resident procures the IT services from a third party and then on-supplies them to a company within the Republic, where both such companies are members of the same group of companies, such services will not qualify for the exclusion. These would typically be global contracts entered into with third-party suppliers for the benefit of all the companies within the group. The explanatory memorandum also indicates that the VAT rules concerning electronic services will apply to intermediaries and platforms. However, this would exclude those intermediaries that are only facilitating payment, that is, pure payment platforms only. The amending regulations will be effective the 1st of April 2019. For a copy of the amending regulations and the explanatory memorandum, please go to our website or app. Also in South Africa, the government has introduced into Parliament the Taxation Laws Amendment Bill 2018, which gives effect to changes which were announced earlier this year. This bill was originally issued in draft form in July for public comment. There are no significant changes between the draft bill and the final bill. Here are the key topics covered in the bill. Please hit the pause button if you'd like to study this list. For a copy of the final bill, please go to our website or app. And now for the developments in the Americas. Let's start in Canada, where I have two updates on litigation. Firstly, in regard to the Eagleus case, which concerns legal professional privilege and which was decided by the Federal Court of Appeal earlier this year. The Supreme Court has now refused to hear an appeal from that decision. That means that the Supreme Court has effectively endorsed the Federal Court of Appeal's view that privilege is not waived when a legal opinion is disclosed on a confidential basis to other parties with a sufficient common interest in the same transactions. Not a good outcome for the tax authorities. And secondly, in regard to the Cameco transfer pricing case, which was recently decided by the Tax Court of Canada. You'll remember that I covered this case in ITB on the 5th of October. Well, it's been reported that the tax authorities have now filed an appeal to the Federal Court of Appeal, but only on the transfer pricing issues. The sham argument is not included in the appeal application. In Colombia, the tax authorities have issued Resolution 51 concerning the VAT obligations of foreign suppliers in regard to inbound B2C services. In many other South American countries, the VAT is collected in such situations via a withholding obligation imposed on payment processors. That option is also available by election in Colombia. However, that withholding system has not yet been established. Until it is, the foreign supplier is required to register for, report, and collect VAT on such transactions. For a copy of Resolution 51, please go to our website or app. Also in Colombia, the government has presented its tax reform bill to Congress. Here are the key elements. The corporate income tax rate, which is currently at an effective 37%, will be progressively reduced to 30% in 2022. The standard rate of VAT will be reduced from 19% to 18% and then to 17% in 2021. And controversially, the current VAT exemption for food staples such as rice, fruit, vegetables and chicken will be removed. For a copy of the tax reform bill, please go to our website or app. In Panama, the amendment law in regard to the multinational headquarters regime, which is called the SEM regime, has now been published in the Government Gazette. For a copy of this amendment law, please go to our website or app. And in the US, the government has released proposed regulations under Section 956, which reflect changes made by the US tax reform legislation. For a copy of the proposed regs, please go to our website or app. And this has been a particularly slow week for treaty developments. All we've had is one treaty enter into force. Well, that's the way it is this Friday, the 2nd of November 2018. I'm Steve Towers. Have a great weekend. So do you know the difference between ignorance and apathy? Or you just don't know and don't care?